When people hear the word stocks, they often imagine chaotic trading floors, people yelling into phones, or green and red tickets flashing non-stop. But owning a stock is actually one of the simplest concepts in finance. A stock is just a small piece of a company. When you buy a stock, you're literally buying a tiny slice of a business. And once you understand that, everything else about that stock market becomes much easier to digest. Imagine your favorite coffee shop. Every morning people line up, business is booming, and you think, I wish I could own a piece of this place. Well, in the world of publicly traded companies, that's exactly what buying a stock allows you to do. Companies like Apple, Tesla, Amazon, or Coca-Cola sell shares so they can raise money to grow. You buy a share and in exchange, you own a fraction of that company. And since you're not a partial owner, your financial outcome is tied to the company's performance. If the business grows and becomes more valuable, your stock usually increases in price. If the business struggles, the stock might fall. It's like planting a tree. If the tree grows strong and healthy, the value of your little branch grows too. Stock prices change every second based on supply and demand. If more people want to buy a stock than sell it, price rises. If more people want to sell than buy, price falls. It's the simplest rule in economics. But behind these movements, there are countless factors influencing the market. Earnings reports, interest rates, news, global events, innovation, competition, even social sentiment. Think of stocks like voting slips. When you believe a company has a strong future, you vote for it by buying its stock. When others agree, demand rises and the price climbs. When sentiment drops, so does price. The stock market itself is a place where all these shares are bought and sold, but it's not a physical place anymore, it's digital. Exchanges like the New York Stock Exchange or the NASDAQ match buyers and sellers instantly, 24/7 around the globe. These are different types of stocks. Some companies are stable, long-term gains, known as blue chip stocks like Apple, Microsoft, or Johnson & Johnson. Others are high growth companies, smaller but expanding quickly, like many tech startups. Some stocks pay dividends, which are like bonuses paid to shareholders from companies' profits. Others reinvest everything into growing. But what makes people invest in stocks? Simple. Over a long period of time, the stock market has been one of the most powerful wealth-building tools in history. Not because you are gambling, but because companies grow. They innovate, they hire people, they create products, they solve problems. And as they grow, so does their value. Of course, the stock market isn't a straight line. It moves in cycles: growth, pullbacks, correction, crashes, recoveries. These movements are fueled by emotions like fear and greed, but also by institutional money flow, economic cycles, and liquidity. Understanding structure, support and resistance trends, and market psychology becomes essential for traders and investors. There are two main groups in the stock market. The investors hold stocks for years or decades. They don't worry about daily price fluctuations. They focus on long-term company growth. Traders, on the other hand, they buy and sell more frequently, sometimes within weeks, days, or even minutes, trying to profit from short-term price movements. Traders use technical analysis, chart patterns, indicators, liquidity zones, order blocks, just like in Forex or crypto. The patterns repeat because human behavior repeats. Institutions don't buy randomly. They use liquidity, order flow, and structure to position themselves, and price leaves visible footprints of those decisions. Investors, on the other hand, analyze fundamentals: revenue, profits, debt, market share, innovation, competition. They want to know, is this company healthy? Is it growing? Does it have potential? But regardless of whether you're a trader or an investor, you're participating in the value of real business. You're owning pieces of companies that make things, build things, create products, and drive the world economy. Another important concept in stocks is market indices, like the S&P 500, the NASDAQ 100, or the Dow Jones. These are groups of companies combined into one index, representing the broader market. When people say the market went up today, they're usually referring to one of these indices. They help measure overall economy health. Stocks are also influenced heavily by earning reports. Every quarter, company announces their profits, losses, and future expectations. These reports can move the stock massively, sometimes in minutes, because they reveal the truth behind the company's recent performance. Let's make it simple with an everyday analogy. Imagine owning a slice of a bakery. The bakery does well. Customers love the cupcakes, sell rice, and more people want to own a piece of it. The value of your slice increases. But if the bakery starts losing customers, struggling with cost, and failing behind competitors, people begin selling their slices, and the value drops. Stocks work exactly like this, just on a global scale. Finally, the stock market rewards patience and discipline. It punishes emotion and impulsivity. The traders and investors who succeed are those who understand the story behind each company, the structure behind each move, and the psychology behind each candle. Stocks aren't just a place to make money. They are a way to participate in the growth of companies shaping our future. When you buy a stock, you're not betting. You are partnering with a business. And once you see it that way, the market starts to make a whole lot more sense.